Well, hey, we're going to take a little time to, we've got a special guest in our studio, special to us anyway, Victoria Bogner, who is our head of wealth planning at Allworth, and she's out, you're out in this part of we're in Folsom, California, Sacramento, essentially.
Beautiful. Kansas City's like 99 degrees right now. So
wait a couple hours. That's all you have to do. No humidity, though.
Yeah, that's true. It makes a big difference.
Yes.
Yeah, and we were chatting, and she has just some good planning with the client. We thought it'd be interesting for her to talk about. So
they bring you in. Well, you're the head of financial planning, but
head of wealth planning.
Wealth planning. So more complicated,
right?
Like super complicated.
So complicated. Yes, we see it all. Let me tell you.
Well, give us your educational background just for a basis to start with.
Sure. I've been in the business since 2005.
Okay.
Started as a temp worker, actually. But my background is in mathematics originally, and computer science. So I stumbled into this career, and along the way became a financial advisor.
You have a degree in mathematics?
I do.
Okay.
That's my true passion, spreadsheets. So I got a degree in mathematics, computer science. Then I joined McDaniel, Knutson Financial Partners in Lawrence, Kansas, became a temp for them, then became an advisor. Then I became the chief investment officer because of my math background, and eventually became the CEO of the company. And in that time, I got my certified financial planner designation, my chartered financial analyst designation, and an accredited investment fiduciary designation, all over the span of 20 years.
The CFA, though, is rough.
That's a tough one.
It is rough. We got marital counseling after that one. 3 years being in the trenches.
That is a rough. Well, and then you joined us 3 years ago?
2 years ago.
2 years.
It's only 2 years.
It's only been 2 years.
Goodness gracious!
I know it feels like I've been here for 20, but it's just 2. Yeah.
Well, when you joined the firm, I remember saying to you, "You're gonna love it here."
Oh, and I do. It's fantastic. I mean, I went from working for a small boutique firm to a large boutique firm. I mean, Allworth is large, but still has that very personal feel. And I love that. I've found that that's pretty rare in our industry, too.
Well, we're glad you joined us.
Yes.
And I don't see you very often, Scott.
I know. I'm looking into your eyes right now.
We're no longer the CEOs of the firm. We brought in someone more experienced than ourselves. Which, by the way, if you're a business owner, it's hard to do.
It's been the right thing for our clients and the right thing for our advisors. There's no question.
He does such a better job than we did.
Absolutely.
He does.
He's pretty great. Yeah.
You've got to give up that. Anyway, back to this client story.
Yes.
Bring us through ages, account size, complications, solutions, the whole bit.
You got it. Okay, so we got 2 clients, married couple, 62 and 60. They came to us with, he worked for a company that I won't name, because then if he's listening to this podcast, it'll be like, oh yeah, that was me. But ABC company, basically his whole career. I mean, he's one of those people that got a job at 22 and worked there for 40 years. But in that time, he participated in the employee stock purchase plan, and then he was also purchasing company stock inside his 401k. So they come to us. They now have a net worth of $7 million. $3 million of it is in ABC stock.
Wow.
Yeah.
And an ESOP and a 401k.
Employee stock purchase plan, so ESPP. So that means that he was purchasing this stock at a 15% discount. It's in
and never sold it? Because sometimes you can sell it every 6 months or whatever. People do that
sold it. No, so he's got a lot of stock with a little bit of cost basis.
By the way,
how
had that stock done the last 10 years versus the broad market?
It's not Apple, okay, I'll tell you that, but it's a good blue chip stock. So it's done pretty well.
So total...
Has it outperformed the market?
It's performed pretty much in line with the market, but still.
So just the only reason I asked, it's an example of taking on more risk without being compensated for it.
Correct. Absolutely. Because inside of his 401k, he's got, $1.5 million of it. And then in the employee stock purchase plan, he's got another $1.5 million.
Were they matching with the company stock? Or was he purchasing it?
Inside the 401k, it was part of his contribution. So they were matching his contribution into the 401k. He was just choosing to allocate some of that to company stock.
Got it.
Right.
Okay, and so $7 million.
$7 million.
And what kind of income did this family make?
He made about $250,000 a year.
Wow. Easily going to be able to replace.
Yes.
Standard of living
Easily.
would go up significantly.
Right. So they can absolutely retire. But of course, the number one question is, and this is very common, I have so much of my net worth, 3/7 of it in this company stock, but it's a ticking tax time bomb, right? I can't just sell it. And
What
then
about
pay.
the 401k? That's an easy one, right?
Well, there's something special that you can do with the 401k if it makes sense. And in his case, it did. He had both preferred shares and common shares inside the 401k. With the preferred shares, that's where the bulk of this was. He only had a cost basis, meaning that he actually put money in the 401k, his own money purchased $100,000 worth of this stock. And the preferred shares were worth about $1 million.
All right, so we had $900,000
of,
and I assume we're going to get to what we call NUA here.
Correct. So what we recommended is for those preferred shares, the common shares, he had very high cost basis. So this doesn't make sense for that, but it made sense for the preferred shares. What you do is you take that $1 million, you move it into a taxable brokerage account. You move the rest of the 401k
in shares.
In shares, yes.
And this only works if the company actual shares in the 401k, not some sort of fund that mirrors the preferred.
Correct.
Or
it's got to be the
units.
actual
Or units.
Because you might
Correct.
others listen. You might work for a company that you have money in the company's 401k and that your company stock, but you don't technically own the shares. You own some sort of
Right. So this is if you own the shares. So you move those shares in kind to a taxable brokerage. You move the rest to an IRA. You got to do it all in 1 year. You got to empty the 401k in 1 year. You can't stagger it. But so you take that $1 million, you move it to a taxable brokerage in those shares in kind. Then what happens is you're only taxed on the $100,000 of basis. That's ordinary income. On day one, that $900,000 of gain is long-term capital gain. Then any growth beyond that million, that's short-term capital gain until you hit the 12-month mark. So you've got three kind of tax buckets going on in that account at the same time.
Why wouldn't you just? I'm sorry, Scott.
I knew this at one point in time, but do you still get a step-up basis upon death too? With that, is it?
Yes,
forgiven?
you do.
Okay.
Yes, you do.
And would you just hold for 12 months and then put collars around it, use options in order to get some downside protection?
Well, here's what we were able to do. So to see the story through a little bit further.
Are we getting ahead of ourselves?
You're getting a little ahead of
excited
yourself.
about this?
Well, and net unrealized appreciation, an example like that, he doesn't have to worry about required minimum distributions anymore.
That's exactly
He's taken
right.
something that went from ordinary income when he withdrew to now he's got dividends taxed at favorable event, capital gains tax at favorable event.
Exactly. On day one, that 900 grand's long-term capital gains, which the top bracket for that's 20%. Ordinary income tax top bracket is 37% as of today. So by doing that, and since he's retiring this year, that will factor in a second. We moved the IRA or the 401k money, the bulk that was left, into an IRA. And then he's also got this employee stock purchase plan with a bunch of this company's stock in it with a very low basis, right? So what we were able to do then is say, all right, we want to go ahead and minimize the amount of time you have to be glued to the earnings report of this company, because if something happens to it, you're going to be sunk, right? So how
let's
do
say if he
we...
retired from GE.
WorldCom,
Or just
GE,
Intel.
Yep. So many different things that can happen. So there are actually a few different strategies that we could employ depending on how much liquidity he needs. But this is the direction we decided to go for him because he wanted the most amount of flexibility and liquidity. So for the money that was originally in the ESPP, okay, that's in a taxable brokerage. We want to go ahead and minimize the risk of that right away without having to sell it. So how do you do that? Well, one way to do it is you can collar it. So what that means is you are basically saying that I can participate in the gain of this stock up to, say, a 15% cap. And after that, I'm willing to sell the future annual gains beyond 15% to buy some downside protection. So let's say my comfort level is...
So essentially, you're going to buy some insurance on it. And the
You're
way
buying-
to pay for it, you say, if the stock just takes off like bananas, I'll forego some of that upswing.
Right. And we're not doing it with all of it. We're doing it with 30% of it, right? Just to take down some of the risk. So you're basically pre-selling future growth in order to fund downside protection. In this case,
But you could just fund downside protection and keep all future growth.
you could, if you want to. If you want to pay out of pocket for
That's
that
right.
downside
That's right.
protection, a lot of folks decide, hey, let's make this a cash neutral event. Okay, so I don't want to have to pay out of pocket for the protection. Let's go ahead and sell some future gain, and then we can fund the downside protection.
And
so,
you start the downside protection at 10% negative, 15% negative?
yeah, it depends on their comfort level. So for them, it was, we'll participate in the first 10% of loss, and then after that, we're going to be fine.
Okay.
And the more loss you're willing to take, then the higher that upside cap is, right? So for them, they were able to participate in the first 15% of gain every year. So this is annually. And then if it went gangbusters and went up 30%, okay, well, on that piece we protected, I guess we missed out on some upside. But for that, we were able to
You're able to pay
protect
for
them.
the capital gain because you just had the big
That's right. So that's another perk, is that we don't then actually sell the stock if it gets called, and this is getting a little advanced, but then we just pay for another stock option to cover that call. It's a loss. Then we get to use that loss to sell some of the stock and write off the gain. So it's really a great strategy. Then in the meantime, we were able to sell enough of the stock that he was still in a 0% capital gains bracket. Okay. So there are lots of different income tax brackets. There's not just your income tax, there's also capital gains tax bracket, there's your IRMA tax bracket, there's Social Security tax bracket, right? So you want to make sure that all of these are working in tandem. So especially in 2026, we can sell a lot of that stock in the 0% capital gains bracket. So then we can take that money and kickstart what's called a direct indexing account. So how that works is, instead of going out and buying the S&P 500 ETF, instead you put it in a direct indexing account where you're buying all 500 individual stocks. It's a beautiful strategy.
And then in this situation, right? Every situation is unique, but
in this
I know where this is
situation, it
going.
works.
Yeah.
So over the course of 2026, some of those stocks are going to do great. Some of them are going to be stinkers. If you hold just an index fund, then you're just along for the ride. But owning 500 individual stocks of the S&P, well, then you can sell the stinkers to realize loss and offset the capital gain from selling some of that stock.
And Victoria, did you
ABC
carve out any part of that direct index from the industry, since he's already had because you only did a caller on 1/3 of the portfolio in the
yeah, you can say I don't want to own that particular company, or I don't
yes,
want the whole industry.
Correct. Yes.
So you went beyond a regular direct index. You actually excluded, let's just say that it was manufacturing. You excluded that sector of manufacturing out of the index.
So what we were able to do is say, okay, in the S&P, we obviously don't want to own more of this particular sector, so let's carve that out, because we already are overweighted in that, and that we have that flexibility to do that. So spot on. Yes, that's absolutely what we did. So then we have this engine now that's producing these capital losses while you're still making the returns of the S&P 500, because you're invested in the entirety of the S&P 500. You're just manufacturing these capital losses so you can sell.
How much more expensive is a portfolio like this versus a regular ETF or
so to add this strategy is a whopping 0.4%. But the amount of tax
just on
alpha,
the direct index.
Yeah, just on the direct index. But you're owning individual stocks, so there's no
correct.
cost to
so
that.
The alpha is incredible.
Yeah, the alpha is amazing, especially in this particular situation where if you sell all the stock outright, then you're paying 20% capital gains tax on most of it.
I'm trying to think of how many different techniques you used in this one client, right? And by the way, if you retired 10 or 15 years ago and you're like, my advisor never talked about this, or they don't talk about it today, the reason this is really, really advanced, and what has brought the cost down significantly is the use of technology in the portfolios.
You're spot on, because 10, 15 years ago, you had to be an institutional investor or somebody with 10 million plus in net worth to even touch some of these strategies.
And it wouldn't have been this inexpensive. It'd be much more expensive. And this is all run by algorithms.
Mm-hmm. Yeah, that's right. Which is a lot more reliable than a human being.
And the cost will continue to fall.
Yeah. Yeah, so these are strategies that are available to the everyday investor, but you need to have an advisor that knows how to put the pieces together to maximize that tax outcome.
Well, and to understand that those pieces even exist.
Yeah, that too.
So in our firm, we have different level of advisors where you specialize in really complex things, right? So they actually refer business up to you and you work in tandem with the advisor. How's it work?
That's right. So the advisor is still the head of the relationship. We're basically their team, right? So they are the coach on that relationship. We are on the advisor's team. So they can bring us in whenever they have the need to have a complex situation evaluated. Then we can do the planning. We can even present the plan to the client. But the advisor is always the head of that relationship.
Well, I always love hearing stuff like this. I mean, Pat, we built this company 30-some years ago, and the stuff that we can do now for average investors,
Crazy.
like this, is so great. So
Crazy.
Vicki, thanks for taking some time to join us.
Absolutely.